I don't reveal it. I don't reveal it because I don't go to any side. I deal on day to day. I am happy if the price of gold is low, then international demands go up. And we exporters are busy and we are working overtime. So if the price goes down, I'll be very happy.
All right, Mr. Parekh, thank you so much for joining us with your sense on the policies and the prices as well. Let's also get on board then Angad Singh Bhatia. He's MD Bezel Group. Also joining us in studios is Vijay Bambani, who's author and CEO BSPLindia.com. Vijay, to you first, and what's your sense really coming in for the sector in precious metals? Because while there is some easing on policies, the major one really seems to be coming.
Manisha, I don't see any urgency on the MCX in terms of buyers hurrying to build up fresh long positions. And therefore, 29,250 to 29,400 on gold and 44,800 to 45,400 odd levels will remain as glass ceilings for gold and silver respectively. I think as and when economic data starts to improve even further from here, I think bullion will remain under pressure at least in the first few months of the calendar year 2014. Thereafter, after the halfway mark through the calendar year, I do expect a perk up in prices, but futures traders, at least on the MCX in the Indian context, are unlikely to make too much money on the long side. A, because of prohibitive cost of carry, and B, because every time you roll over your long positions from one derivative cycle to the other, you're barely even, if at all, able to recover your cost of carry, and therefore you're forced to sell at a loss. Unless at least you see a previous swing high being overcome, the cost of carry being recovered by the bulls, I don't see how the bulls can come back in strength. So I would remain of the opinion that you should stay away from the leveraged long space. If at all you need to buy the dips on silver rather than gold, and that too at sub 42,000 or 42,000 levels.
Angad, getting you in the conversation as well, what's your sense for the near term and the longer term in case of the precious metal prices? How should a trader and an investor approach this space now?
Well, I'm also bearish on gold and silver, especially with the U.S. economy strengthening and all. People are more or less selling gold and getting into more riskier assets. So I'm looking at a level of 28,200 with a stop loss of around 29050. And for silver, I'm looking at 43,000 and 44,900 as a stop loss. So there's an FOMC meet in the evening also, and the U.S. government is moving the money out of the economy, and they're getting more confident about the U.S. economy. So people are moving into more riskier assets and out of gold.
True that, Angad. Also, how would you look at the energy space then? Because the previous week has seen a decline of 6%. We have started 2014 on a very weak note, really. And this week also, while today seems to be a slightly positive day, this week has seen more than 2% of a decline coming in yet again. How are you now targeting this sector?
Well, yeah, the crude has fallen quite a bit in the last week or so, and we are still bearish on it. We are looking at a target of 5,600 with a stop loss of 5850. Although the crude oil inventories have gone up a bit, but the distillates and gasoline stockpiles are rising. So maybe that's the reason, that there's more stockpiles of gasoline and distillates.
Vijay, how would you look at the natural gas prices now? Because while the cold winter in US and else has supported the prices, but it really is the forecast of milder weather following which really seems to be weighing on.
Manisha, I remain bearish on natural gas prices. Even yesterday we talked about the fact that the cold snap in the US is a discounted fact because the entire data is available in the public domain, and if at all prices in natural gas had to flare up, they had everything that they had in terms of trader sentiment to flare up. The fact that they didn't means they are likely to test lower levels. Now, as far as levels are concerned, 255 odd levels might just see a short covering base rally as bears lock in their profits, with some amount of buying coming in from sporadic value buyers. But I'm not very keen on buying in large quantities also at 255 levels. It will at best be a tradable bounce. If at all you see prices of 255 and you buy there, you're unlikely to go past the 265 odd level. So it's a tradable bounce at best where you can risk some money rather than trade with confidence.
Angad, how would you look at the base metal sector? Because while there have been some financial curbs in China and that could be putting pressure, you also have a strong US dollar there. But having said that, as you were pointing out, there is more data today. Tomorrow also there's the non-farm payroll figures coming in from US. Ahead of all of these big numbers, how would you approach?
Well, we are still bearish on the base metals, and as you have seen in the last week, they've fallen also quite a lot. They were range bound for nearly a month, but suddenly they've moved out of that range. And even with people were expecting, like in nickel and all, they were expecting the Indonesian government to ban export, but they've not done that. So their base metals have fallen. And in nickel we are bearish, and we got a target of 820 and a stop loss of 845. And for copper we've got a target of 452 with a stop loss of 464.
Vijay, how would you look at this sector? I mean, you're not a keen buyer here, but do you think this space could see further declines? Is shorting perhaps an idea then?
I think so, yes. I would still look out for elusive signs, and I use the word elusive here as predominant. The signs of traders showing keenness to buy is extremely elusive. I'm not seeing any kind of even sporadic concerted buying coming in from any kind of traders. So the rally in December should now be very safely attributed to hedge funds shoring up their NAVs, because hedge funds tend to be the largest and the most dominant players in the international commodity markets. And what you are seeing is a combination of hedge fund unwinding as well as the psychological impact of taper coming into play, because easy money has always been mother's milk to a bull market, and now you're seeing the taps slowly turning to basically stop that supply of easy money. So my guess is there will be a steady decline in prices. I don't see a very sharp meltdown or a sharp sell climax here. But if you're a buyer, you're going to see prices trickle down day by day, and you're mounting mark-to-market losses. So if at all you need to trade, it should be on the short side. But because prices are going to trickle down rather than plummet downwards, your profits are also likely to come with a great deal of patience and effort. So you need to be very careful about where you short. Copper, if at all you see prices going past the 462 levels, then you could short. Aluminium, if you see prices go past the 109.5, 110 odd levels, then you could short. Nickel, if you see prices of 844 and above, you could short. So, and basically you'll have to fund these positions because prices are likely to decline in a very calibrated fashion.
Okay, so no convincing buying call coming in for the base metal prices. There is shorting where you could really be making money in that sector. With that, Angad, we'll let you go. Thank you so much for